Today we're going to look at illustrating the ratios. And we're going to apply financial ratio analysis in a comprehensive fashion to help us evaluate the financial performance of a company. Ratio analysis consists of determining the relationships between the different financial statements. We compare the ratios from prior years and those of other companies to help us analyze 5 major categories. We're going to analyze profitability, look at liquidity, financial risk, or what we also call long-term solvency, operating asset management, so how we're using our assets in our operations, and our market strength or our position. One thing we should keep in mind, as we've pointed out through the various different chapters, is that some companies do report their financial information using both generally accepted accounting principles and international financial recording standards. And when that's done, if they present their financial information in 2 different fashions, one should keep in mind that you should not use the ratio analysis to compare the financial statements in the across the 2 different measures. You should only compare like to like. So if you're comparing, say, Starbucks or Walgreens using international financial reporting standards, and then you should use it also to their competitors. And the same goes if you're using GAAP. You should make sure when you're looking at the financial statements of that company, you should be comparing it to other companies who are also using or preparing their financial statements using GAAP. So let's look at the first type of financial ratios, evaluating profitability. We're going to look at 3 different types of profitability ratios: profit margin, asset turnover, and return on assets. First, we have the profit margin measure of net income to sales. So what we're going to look at here is we're going to look at, for every dollar of sales, how much net income are we producing. We're going to look at it and look to see if we've improved from year to year, and we're going to see how we compare to other companies. And the ratio calculation there is at the bottom of the screen, and we can see that with our company here, net income over sales, we can see that the ratio from 2008 to 2009 went from 3% to 4%. So that's clearly an improvement. Their profit margin, profitability, increased by 1 percentage point. And we're going to look at these to see how closely our company's profitability is linked to its liquidity, because ultimately we want to be able to produce cash flow for our company. Next ratio is our asset turnover. It measures how efficiently our assets are being used to produce sales. And as we can see, this calculation is net sales over or divided by our average total assets. And our average total assets is calculated by getting our beginning plus our ending assets and dividing them by 2. So what we can see here in 2008 to 2009, first thing, if we just isolate the numerator, our net sales, we can see that our net sales went down slightly from 2008 to 2009, and our total average assets increased. So while our total average assets increased slightly and our sales went down, that means that we are maybe slightly less able to produce sales for the same level of assets. So our asset turnover got just a little bit weaker this particular year. Then our next measure of profitability is our return on assets. Return on assets. This measures a company's overall earnings power or profitability relative to each dollar of assets. And we can see that for our company, its return on assets increased from 5.7 to 6.9, and our calculation is our net income over our average total assets. And in all likelihood here, if you go back to our first ratio, the profit margin, we can see that we noted in that slide that we were slightly more profitable from 2008 to 2009. So that's going to be a contributing factor as to why our return on assets got better during the period. So if we were analyzing the profitability ratio relationships here, we can see that our return on assets improved in 2009 because of an increase in the profit margin, but that was partially offset by a small decline in the average, in the asset turnover ratio. Although the company's profitability and total asset management were relatively low, it was good at generating cash from their return on assets. So one thing we need to keep in mind when we're analyzing our profitability, that first ratio that we were looking at, is we don't want to only look at profitability in isolation for this particular reason, because sometimes our profitability includes what we call one-time items, and we've talked about these before. These might be the gain on the sale of a building or other asset that might boost the net profit margin, but not necessarily be a function of the operations of the business. So therefore, it's unlikely that that can add to the profitability every year. So we have to be careful and pay attention to that. What's increasing our profits for a particular year, and make sure it's not one-time items that are increasing their profits. Want to look at not just the net profit margin, but you also want to look at the operating profit margin. Next, let's look at how we evaluate our liquidity by looking at the current ratio, quick ratio, cash flow yield, cash flows from sales, cash flows to assets, and our free cash flow. First, our current ratio. It measures our short-term debt paying ability by comparing our current assets with our current liabilities. Simply stated, it's our current assets over our current liabilities. And in this particular example, we can see that from 2008 to 2009, our current ratio got a little bit better. So it basically is giving us an indication that we are more able to repay our current liabilities during 2009 compared to 2008. Generally speaking, as a rule of thumb, we want this number to be greater than 1.0 or greater than 1 time. To a certain extent, the higher the number in this ratio, the better. Next, we have the quick ratio. And the numerator in the quick ratio is basically our current assets minus inventories and prepaid expenses. What we want to look at here is just our items that are most quickly converted to cash. So that would be cash itself, our marketable securities, and our accounts receivable. And that's the numerator in this particular formula over our denominator, which is our current liabilities. So we're looking here at our quick liquidity, if you would, or how if we had to get rid of our assets very quickly what of those assets could be used to cover our current liabilities. So again, another measure of liquidity, and again we could see that from 2008 to 2009, our company's ratio got better. Our cash flow yield ratio measures a company's ability to generate operating cash flows in relation to its net income. And again, this formula is our net cash flow from operating activity over our net income. We're going to get that net cash flow from operating activity directly from the cash flow report, right where it says net cash from operating activities. And this number, while it declined slightly for our company here, it still is a solid reflection of our cash flow generating capability. It's a relatively strong reflection here for this company because its cash flow from operations is 3.6 times its net income. That means they're able to turn over their assets relatively quickly. And if you think about it, with a company like Starbucks, that makes a lot of sense because most of their sales are going to be in cash instead of on account. Company like Starbucks, they're, mostly everybody's going in there and either paying cash or paying something on credit card, which is essentially from a retail sales company's perspective, it's the same as cash. Next, look at our cash flow to sales. Again, this refers to our ability to generate operating cash flows. Our cash flow to sales increased from 2008 to 2009. Again, we're going to have as our numerator the net cash from operating activities, which is from the cash flow report, and divided by our net sales. And it went from 12% to 14%. Our cash flow from operations increased even though net sales declined. It's showing that even though sales declined for the year, the company is still capable of generating good cash flow from its operations. This would be a ratio you would want to continue to monitor because the company would want to keep evaluating the sales trend to make sure it turns around. This is one of those ratios that show the importance between the different components of the financial statements. Next, we have the cash flow to assets, and this measures our ability to generate assets, the ability of our assets to generate operating cash flows. So our numerator here is our, again, net cash from operating activities, and that's going to be divided by our average total assets. And again, this particular number went up from 22.9% to 24.7%. And basically this is indicating that our cash from operations increased at a proportionately faster pace than the average total assets for the year. And then lastly here, we're going to look at our free cash flow. This is a measure of the cash remaining after providing for commitments. So we want to look at, if we took our cash from operations and we had to repay certain commitments or pay for certain commitments, how much free cash would we have left over at the end? So we're going to take our net cash flow from operations, again, from our cash flow report. We're going to take our dividends, which is down lower in our cash flow report, and we're going to take our net capital expenditures, which is also down a little bit lower in our cash flow report. And the balance of these gives us our free cash flow. Next, we're going to look at our financial ratios relative to evaluating financial risk. Our debt-to-equity ratio, our return on equity ratio, and our interest coverage ratio. So, Our debt to equity ratio, it's going to measure our capital structure and leverage and show how much a company's assets are provided by creditors compared to by stockholders. This is generally considered a good thing when this particular ratio goes down. We want to try to look at this ratio to stay at or below 1.0 times. And as we can see with our company from 2008 to 2009, their ratio went from 1.3 times to 0.8 times. Next, we're looking at a return on equity, and this measures our return to stockholders or profitability of a stockholder's investment. And again, the numerator here is the net income, and our average stockholders' equity is the denominator. So we're going to take our beginning stockholders' equity plus our ending stockholders' equity divided by 2. And just a reminder here, our beginning stockholders' equity is the ending stockholders' equity from the previous year. And in this particular case, our return on equity went from 13.2% to 14.1%, and this increase is probably largely attributed to the company's proportionally greater increase in net income in the year compared to its equity. So you can see how these numbers went. Next, we're going to look at our interest coverage ratio, and this measures our degree of protection creditors have from default on interest payments. So how likely are we to pay the interest component of our debt repayment? And it's used to determine whether a company's interest payments are in peril or at risk. And we could see this calculation as our interest income our income before taxes, plus we're going to add back our interest our interest expense, and we're going to divide this number by our interest expense. So again, these numbers are all going to be found on your income statement, your income before taxes and your interest expense, and then divided by our interest expense are all on the income statement. And we could see that for this particular year, the company's ratio improved from 2008 to 2009, and it looks like it's maybe in part partially attributed to the fact that their interest expense did decrease from 2008 into 2009. Next, we're going to evaluate our operating asset management. And we're looking here at the operating cycle, which consists of our inventories, accounts receivable, and accounts payable, and spans the amount of time to purchase, sell, and collect on our inventory. And we're going to also look at the financing period. This is the period of time in which a supplier must be paid, and the end of the operating cycle. Financial ratios that measure operating asset management are inventory turnover, inventory on hand, the days we have our inventory on hand, our receivable turnover, so how quickly we collect or turn over our receivables, the average number of days it takes us to collect our receivables, and our payable turnover, how quickly we repay our payables, and then lastly, how many days we have our payables on hand. Successful companies manage the operating cycle by managing their operating assets and their operating payables, and really monitor the financing period. Depending upon the periods between the ending of the operating cycle and when suppliers must be repaid, it will impact a company's ability and need to borrow from creditors to support their operations. So these are matters that definitely are important to a company, these measures. So they monitor them very closely. And then you can, if you're an outside analyst looking at a company, you're going to look at these numbers and see how they do compared to their competitors. Not only comparing them to themselves, but to their competitors, to see whether or not your company's operating asset management is more efficient than other companies that are similar to your company. So first, let's look at the inventory turnover. This measures the relative size of our inventories, and this number can be found by looking at the cost of goods sold and dividing it by the average inventory. Again, our cost of goods sold is going to be found in our income statement, and our average inventory is going to be the beginning plus the ending inventory divided by 2. As we can see here, our inventory turnover decreased from year to year because the cost of goods sold decreased proportionately more than did the average inventory. Basically, this means that they turned their inventory over fewer times during the year. This would demonstrate a slight weakening in their inventory turnover. So we want to look at that in this company. They're turning their inventory over 6.4 times in a year. Okay. The flip side of that is the average days of inventory on hand, and this measures how long they're keeping their inventory on hand within the company before they're selling it. And again, here we see that the inventory turnover days increased from 54.5 days to 57 days. And that would make sense if we flip back to the previous page for just a minute. If we turned over our inventory a little bit slower this year, that would reflect in us having our inventory on hand for more days during a year. So again, this is a slight weakening. This is meaning that maybe our inventory is not as well liked from 2008 to 2009. Maybe for some reason our company, our customers rather, didn't particularly care or didn't shop in our store as frequently, and so therefore we had our inventory on hand a little bit longer. You got to also keep in mind that having that inventory on hand a little bit longer is going to weaken your cash flow a little bit, because you can't turn it to cash as quickly if you're selling your inventory a little bit slower. Let's look at our receivables turnover. Our receivables turnover basically measures the relative size of our accounts receivable and the effectiveness of our credit policies, meaning how good a job are we doing at knowing whether we should sell something to somebody on account. Do we have a lot of bad accounts receivable, or are we able to collect relatively quickly on our accounts? And we could see here, again, this number is going to be our net sales over our average accounts receivable. And we can see here that our turnover is relatively high for this particular company. So we're turning over our accounts receivable 32.5 times compared to 33.6 times. Both numbers are relatively high. Again, we would expect that if a company has a lot of cash sales as opposed to a lot of sales on account. This did weaken slightly again because we turned over our accounts receivable 32.5 times compared to 33.5 times. So this would be a slight weakening or use of cash for the year. And again, this relates to our days of days of accounts that we have left our accounts uncollected. It measures the average days it takes us to collect our accounts receivable, and again, it took us slightly more days to collect our receivables in 2008 compared to 2009. We could see that in this particular formula, our days in the year are the numerator, and the denominator is our receivable turnover. So the denominator of the previous formula is the solution to the previous formula, the receivable turnover, is the denominator in in this formula. And that holds true. I believe I did not state that on the inventory turnover ratio. Back here, the average days inventory on hand. The denominator is the inventory turnover ratio here as the denominator. Sorry about that. Then we have our payables turnover. This measures the relative size of our accounts payable and the credit terms that creditors extend to our company, and it measures how many times during the year they turned over their payables. And in this particular case, we turned over our payables 14.5 times versus 13 times. And so in this particular year, this resulted in us using slightly more cash from one year to the next because we turned over our payables that much more quickly. And again, like our previous measures, our numerator is going to be our 365 days and our denominator is our payables turnover. And this measures the average number of days it took us to pay our accounts payable. So we paid slightly more quickly here, 25.2 days versus 28.1 days. And again, this would result in a slight decline in our cash flow. And when we look at this number compared to our inventory days and our accounts receivable days, since these collected more slowly, one would expect that the cash flow would have declined because we collected our accounts and slowed our inventory down, but yet we paid our payables a little bit more quickly. Now look at the overall operating asset management. It's going to be assessed in part by computing the financing period. We're going to compute the financing period by taking the days of inventory on hand plus the days of sales that go uncollected, so those two previous calculations, and subtract from that the days of our payables. So we can see that in 2009 our financing period was 43 days and our financing period in 2008 was 37.3 days. So this is a little bit worse because our days, the days that we needed financing in 2009 were slightly higher. So this would typically result in a higher interest expense, except that if we go back to that first slide with this particular company, one of the first slides where we talked about the interest expense, that wasn't the case. The only thing that we can surmise with that is that even though their financing period was a little bit longer, the company, the interest rates in the economy was probably a little bit better in the 2009 period than the 2008 period. And so because interest rates were lower, their interest expense probably was still a little bit lower. So we're going to lastly look at evaluating market strength here by looking at our price to earnings and our dividend yield. And our price to earnings ratio measures investors' confidence in the company and its market price per share relative to its earnings per share. It can be used to compare two different companies and the value of their shares in relation to the values of the overall stock market. A higher price-earnings ratio indicates that investors obtained less earnings per dollar invested. So even though the company increased its earnings per share, the denominator here, per share, the price-earnings ratio declined because the overall market value of the stock increased proportionately less from 15 to 17. The earnings per share grew faster than the market stock price did. So it's just that the implication here is that investors are not all that confident with the company's ability to generate earnings and continue to grow in the future. Sorry, I think program turned off for a second there. So basically, it's basically saying that the implications to investors are that it is not as confident in the company's ability to generate earnings and continue to grow in the future as it did in the past. So it's something to keep in mind, because their stock price did not, was grew proportionately slower compared to the earnings per share. And if we look at our dividend yield, in this particular case, our company did not actually provide any dividends. They did not distribute any dividends to stockholders. So this particular measure for this particular company cannot be calculated. But the calculation would be the dividends per share divided by the market price per share. The dividends per share can be found in the company's financial statements, and the market price per share would be found out in any investment report, or you can go online to CNN or MSN and find that information on where the market stock price is. And that's it for our notes for Chapter 13. You guys can look at this company and look at the different effects of the different profit margins and see how these different types of transactions would affect each of the measures that are indicated there, whether it increases, decreases, or neither. Okay, I think that's it. This is the solutions if you would like to look at it afterwards.